Jake maxes out his 401k. Marcus maxes out his Roth IRA. They both put away money for 30 years. Both retire at the same time. Both think they played it perfectly. They're both wrong. Because one of them forgot to count what the government takes on the way out, and the other forgot to count what he gave up on the way in. And when you actually run the numbers through a full retirement, the gap between what they think they have and what they actually get to keep will make you rethink everything. Let's keep this fair. Jake and Marcus are the same age, 30 years old. They both earn $75,000 a year. Same city, same tax bracket, same goal. Retire comfortably and never have to worry about money again. The only difference is which account they choose. Jake enrolls in his company's 401k. His employer offers a 4% match, meaning for every dollar Jake contributes up to 4% of his salary, the company puts in $1 too. That's $3,000 a year in free money. Jake contributes 10% of his salary, $7,500 a year, and with the match, $10,500 goes into his account every single year, all pre-tax. Jake's paycheck barely feels the hit because Uncle Sam hasn't touched that money yet. Marcus opens a Roth IRA and contributes the maximum, $7,500 a year. No employer match, no tax break on the way in. Every dollar Marcus puts in has already been taxed. His paycheck feels lighter than Jake's from day one. Jake's co-workers see his 401k balance climbing and ask him for investing tips. Marcus tells people he has a Roth IRA and gets a polite nod followed by silence. Nobody at a barbecue has ever said, "Let me tell you about my Roth IRA." It doesn't sound exciting. It doesn't feel like a power move. But feelings and math are two very different things. For the first few years, Jake looks like a genius. His 401k contributions lower his taxable income by $7,500 a year. At his tax bracket, that saves him about $1,650 in federal taxes every single year. That's real money back in his pocket right now. Not in 30 years, not in some hypothetical future. Right now. And then there's the match. Jake puts in $7,500, his employer adds $3,000, and by the end of year one, his account has roughly $11,200 in it. By year 3, he's sitting at about $36,000. By year 5, he's crossed $64,000. More than $12,000 of that came from his employer alone. Money Jake never earned, never saved, and never paid a dime of tax on. Yet. Marcus, by year 5, his Roth IRA balance is about $46,000. Solid, but noticeably smaller than Jake's. And every dollar Marcus contributed came from money he already paid taxes on. At his 22% marginal rate, Marcus effectively needed to earn about $9,600 in gross pay to put $7,500 into his Roth. Jake needed to earn $7,500 to put $7,500 into his 401k because the tax bill on that money doesn't exist yet. Jake's account is bigger. Jake's paycheck is bigger. Jake got free money from his boss. On every visible scoreboard, Jake is winning. And he's not shy about it. But here's what Jake doesn't see. Every single dollar in his 401k has a tax bill attached to it. He just hasn't opened the envelope yet. The 401k is the most popular retirement account in America, and there's a reason for that. The tax break feels incredible, but there's a difference between a tax break and a tax elimination. The 401k gives you the first one. It never promised you the second. Every dollar Jake put in pre-tax and every dollar of growth on those contributions gets taxed as ordinary income the moment he takes it out. Not capital gains rates, not some special retirement rate, ordinary income tax. The same rate he'd pay on a paycheck. If Jake withdraws $60,000 a year in retirement, the IRS treats that the same as if he earned $60,000 at a job. After the standard deduction, he's looking at roughly $5,000 in federal taxes on that withdrawal. Every single year, and here's a rule that catches a lot of people off guard. Starting at age 73, Jake has to take money out whether he wants to or not. They're called Required Minimum Distributions, RMDs. The IRS isn't going to let that tax-deferred money sit there forever. If Jake's 401k has grown to $2.6 million by age 73, which is realistic at 7% annual growth, his first required withdrawal is roughly $98,000. That's not optional. That's not flexible. And he owes income tax on every penny of it, potentially pushing him into a higher bracket than he was in during his working years. Then there's the Social Security trap. Jake's 401k withdrawals count as income when the IRS decides how much of his Social Security benefits to tax. If his combined income crosses certain thresholds, up to 85% of his Social Security becomes taxable. That's money he already paid into his entire career, now getting taxed again, partially because of his own retirement withdrawals. And if Jake ever needs money before age 59 and a half, he's paying income tax plus a 10% early withdrawal penalty. A $30,000 emergency withdrawal at age 50 costs him roughly $9,600 in taxes and penalties. He walks away with about $20,400. That's the price of touching your own money early. None of this means the 401k is a bad account, but it means the number Jake sees on his statement isn't his number. Part of it belongs to the IRS. He just doesn't know how much yet because that depends on tax rates that haven't been written yet, in a future he can't predict. If I only showed you the downsides of the 401k, I'd be doing what every Roth IRA influencer does. The Roth has real limitations that people love to gloss over. The contribution limit is painfully low. In 2026, Marcus can put in $7,500 a year. Jake can put in $24,500 into his 401k, more than 3 times as much. And that's before the employer match. If both of them were trying to shelter as much income as possible, the 401k wins on sheer volume, and it's not even close. There's no employer match on a Roth IRA. Nobody's handing Marcus free money. That 4% match Jake gets is worth $3,000 a year. And over 32 years with compound growth, that match alone turns into roughly $354,000. Marcus has to generate every single dollar of his retirement balance himself. And then there's the income ceiling. If Marcus's career takes off and he starts earning more than $153,000 as a single filer, his ability to contribute to a Roth IRA starts getting phased out. Above $168,000, he's locked out entirely, at least through the front door. There are backdoor strategies, but they add complexity and most people never bother. There's also the cost nobody talks about, the opportunity cost of paying taxes up front. Every year, Marcus pays roughly $1,650 more in taxes than Jake does because his contributions aren't deductible. Over 32 years, that's about $52,800 in taxes Marcus paid that Jake didn't. If Jake had invested that $1,650 a year in tax savings into a regular brokerage account at 7% growth, it would have grown to nearly $195,000. That's real money Marcus left on the table. And here's the uncomfortable truth nobody in the Roth IRA fan club wants to admit. If tax rates somehow go down in the future, and that's unlikely given the national debt, but it's not impossible, Marcus overpaid. He locked in today's tax rate when a lower one was waiting for him. For the first 5 years, the gap between Jake and Marcus is obvious, and it favors Jake. But somewhere around year 7, something quiet starts to happen. The gap stops growing as fast, and by year 10, the story starts to shift underneath the surface. By year 10, Jake's 401k, with his $7,500 in annual contributions plus the $3,000 employer match, has grown to about $155,000. Marcus's Roth IRA, with $7,500 a year and no match, is sitting at about $111,000. Jake's ahead by roughly $44,000 on paper. Solid lead. But here's the question nobody asks. How much of Jake's $155,000 is actually Jake's? At a 22% tax rate in retirement, about $34,000 of that belongs to the IRS. Jake's real after-tax wealth is closer to $121,000. Marcus's $111,000? Every penny of it is his. No asterisk, no footnote, no future tax bill. The gap just got a lot smaller. By year 20, Jake's balance is around $461,000. Marcus is at about $329,000. Jake looks like he's winning by $132,000. But if Jake had to liquidate at a 22% tax rate, his after-tax value is roughly $360,000. Marcus keeps all $329,000. The real gap is $31,000, and almost all of it is the employer match. Take the match out of the equation, and they're nearly dead even. This is the part that breaks most people's brains. The 401k looks bigger on every statement, every year, for the entire time you own it. But a meaningful chunk of that balance was never yours. It was always the government's. You were just holding it for them. After 32 years of consistent investing, Jake and Marcus both retire at 62. Let's see where they stand. Jake's 401k balance, approximately $1,238,000. That's a seven-figure retirement account, and it feels incredible. Jake worked for 3 decades. His employer kicked in $96,000 in matching contributions. The market did the rest. On paper, Jake is a 401k millionaire. Marcus's Roth IRA balance, approximately $885,000. No seven-figure milestone, no bragging rights at the retirement party, just $885,000 that is 100% his, tax-free, forever. Now they both start withdrawing $60,000 a year. Jake pulls $60,000 from his 401k. The IRS treats it as ordinary income. After the standard deduction, his taxable income is about $44,300. His federal tax bill, roughly $5,100. After taxes, Jake takes home about $54,900, and if he lives in a state with income tax, he's paying that too. Marcus pulls $60,000 from his Roth IRA. His federal tax bill, $0. His take-home, $60,000. Every single dollar. That's a difference of about $5,100 a year. Over a 25-year retirement, Jake pays roughly $127,000 in federal taxes just on his withdrawals. Marcus pays nothing. But it gets worse for Jake. When Jake starts collecting Social Security, let's say $24,000 a year, his 401k withdrawals push his combined income high enough that up to 85% of those Social Security benefits become taxable. That's an extra $2,400 a year in taxes that Jake pays simply because of where his retirement money is parked. Over 25 years, that's another $61,000. Marcus's Roth withdrawals? They don't count toward that calculation. Marcus may keep more of his Social Security tax-free. Add it up. Over a 25-year retirement, Jake could pay somewhere around $188,000 in federal taxes on money he thought was his. Marcus pays close to $0. Jake still has a larger starting balance. But the after-tax gap is dramatically smaller than the statement gap. And depending on future tax rates, which could go up, Jake's disadvantage could grow even larger. Here's a scenario neither of them planned for. At age 50, life throws a curveball. Maybe it's a medical bill, a family emergency, or an opportunity that requires cash immediately. They both need $30,000. Jake goes to his 401k. He's under 59 and a half, so he pays a 10% early withdrawal penalty. That's $3,000 gone immediately. Then he owes income tax on the full $30,000 at his 22% marginal rate, another $6,600. Out of his $30,000 withdrawal, Jake walks away with about $20,400. He needed $30,000 and he got 2/3 of it. Marcus goes to his Roth IRA. Here's something most people don't know about the Roth. You can withdraw your contributions at any time, at any age, with 0 taxes and 0 penalties. Not the earnings, just the contributions. Marcus has put in $150,000 over 20 years. He pulls out $30,000 of that. No penalty. No tax. He keeps all $30,000. Same emergency, same dollar amount. Jake lost $9,600 to penalties and taxes. Marcus lost nothing. The Roth IRA is not just a retirement account, it's the most flexible emergency fund most people don't realize they have. If I left the story here, I'd be doing exactly what I accused the Roth IRA influencers of doing, telling half the truth. The 401k has real structural advantages that the Roth can't touch. The employer match is the single greatest return on investment in personal finance. If your employer matches 4% and you don't contribute at least 4%, you are leaving free money on the table. That match, compounded over decades, is worth hundreds of thousands of dollars. In Jake's case, his employer's $96,000 in match contributions grew to roughly $354,000. Marcus has no version of this. None. The match alone is worth more than the entire Roth tax advantage for most people. The contribution limit is 3 times higher. If you're in your peak earning years and want to shelter as much income as possible from taxes, the 401k lets you put away $24,500 a year. The Roth IRA caps you at $7,500. If you're a high earner trying to reduce your current tax bill, the 401k is the more powerful tool. If you're in a high tax bracket now and genuinely expect to be in a lower bracket in retirement, maybe you're paying 32% now and expect to withdraw at the 12% or 22% bracket, the 401k math actually works in your favor. You defer at a high rate and pay at a low rate. That spread is real profit. For high earners who exceed the Roth IRA income limits entirely, the 401k might be the only tax-advantaged option available without getting into backdoor strategies that most people find intimidating. And let's not underestimate the power of forced discipline. The 401k comes out of your paycheck automatically before you ever see the money. You can't forget to contribute. You can't accidentally spend it. For the majority of people who struggle with consistent saving, that automation alone is worth more than any tax strategy on paper. The Roth IRA wins in situations that are specific, identifiable, and increasingly common. If you're young and early in your career, earning $40,000 or $55,000 a year, you're in one of the lowest tax brackets you'll ever be in. Paying taxes on your contributions now at that low rate and never paying taxes on decades of growth, that's a bet most financial planners would take every time. No required minimum distributions. Ever. Jake's 401k forces him to withdraw and pay taxes on money starting at age 73 whether he needs it or not. Marcus's Roth IRA can sit there untouched for as long as he lives. If Marcus doesn't need the money at 73, it keeps compounding. If he lives to 90, that's 17 extra years of tax-free growth that Jake's account can't replicate. Tax-free withdrawals give Marcus total control over his tax bracket in retirement. If Marcus has some Social Security income and a small pension, he can pull from his Roth without adding a single dollar to his taxable income. That means lower Medicare premiums, less tax on Social Security, and more control over how every dollar flows. Jake doesn't have that option. Every withdrawal pushes his taxable income higher. For estate planning, the Roth IRA is one of the cleanest assets you can pass to your heirs. If Marcus dies and leaves his Roth to his children, they inherit it tax-free. They'll have to withdraw it within 10 years under current rules, but they won't owe income tax on any of it. Jake's kids inherit a 401k, and they owe income tax on every dollar they take out. Same inheritance, very different outcome. And here's the one that keeps policy analysts up at night. The United States national debt is over $36 trillion. Federal spending isn't going down. The odds that tax rates stay this low forever are, let's be honest, not great. If rates go up even modestly, every dollar in a 401k becomes worth less, and every dollar in a Roth becomes worth more. The Roth is a hedge against a future that most people aren't planning for. Jake and Marcus both walked away from that decision thinking they made the smart play. Jake thought the 401k was the obvious choice. Bigger tax break, employer match, higher limits. Marcus thought the Roth IRA was the smarter long game. Tax-free growth, no RMDs, total flexibility. Neither of them was wrong, but neither had the full picture. Here's what actually works for most people, and it's not one or the other. Step 1, contribute to your 401k up to the full employer match. If your employer match is 4%, you put in 4%. That match is free money with a guaranteed 100% return on day one. Walking away from that is walking away from the single best deal in personal finance. Step 2, max out a Roth IRA. Take your $7,500 and put it where the government can never tax it again.